ETFs are some of my favorite assets to invest in because they make investing really simple and are especially great for long-term buying and holding. And there are, of course, hundreds of different ETFs to choose from, but today I wanted to talk about just two Schwab ETFs that together not only beat the S&P 500, but in my opinion are really the only two ETFs you need in a growth portfolio. So in this case, it's a two-fund portfolio consisting of both SCHD and SCHG. And then towards the end, we're going to figure out if this two-fund portfolio is actually better than just investing in the S&P 500, for example, only buying an ETF like VOO. So starting with SCHG, this is the Schwab US Large Cap Growth ETF. And because it's filled with such fast-growing, high-quality companies, it's had pretty amazing returns recently. Its one-year return is just under 40%, with a 5-year total return of 135%. And because it's purely focused on high growth, it doesn't pay much of a dividend, it's less than 0.5%. But like we just saw, because of how much it grows when we're in a healthy bull market, the gains make up for the lack of a dividend yield. These Schwab funds also have really low fees, so with SCHG, you're only paying 0.04% of your investment. So even if you had $100,000 in this fund, you're only paying about $40 a year. And as stocks have been performing really well this year, the share price is right near its 52-week high of $93.84, with a current share price of $92.91. And if we look at its holdings, they are going to be very similar to the S&P 500, but because it's more focused on growth, it's a lot more concentrated in the Magnificent Seven stocks, with Microsoft being at 12.2%, Apple at about 11%, and Nvidia at 9%. And these top 10 holdings make up just under 60% of the entire portfolio, which is quite a lot considering it holds 250 different stocks. So with this much weighting towards these large cap tech companies, it makes the fund a lot higher risk, which is why I think it's important to pair it with SCHD. And the reason why is because SCHD has a lot more unique holdings in its portfolio, and it's a completely different fund compared to SCHG. It's a lot more focused on high value stocks with a good mix of dividend growth. In fact, the overlap between the two funds is only 1%, and you honestly can't get much better than that. So adding SCHD is going to bring down the volatility and lower the risk in this two-fund portfolio. And it's also going to increase the amount of dividends you'll be getting each quarter, since it has a current dividend yield of 3.4%. Now, I'm sure at this point you probably know quite a bit about SCHD, and you might be wondering, why not just put everything into SCHD? And some people do. But for me personally, it's just not something I would ever do, and here's why. Because the fund is catered more towards dividend investors and focused more on dividend income, it leads to some years underperformance of the broad market. For example, since about January 2023, SCHD has been underperforming SPY by a pretty significant margin. And even on the 10-year chart, SPY still beats out SCHD in terms of total return, so that it is including dividends reinvested. So in my opinion, SCHD alone just doesn't quite move the needle for me. With that being said, in order to consistently beat the market with this two-fund portfolio, you're going to have a lot more weighting towards SCHG with about a 70-30 split. So now let's compare this two-fund portfolio against the S&P 500 to see how it's performed over the last 10 years or so. Jumping into our portfolio backtesting tool here, and starting in 2012 when SCHD was introduced to the market with $10,000 and adding $500 a month to each portfolio, as well as reinvesting the dividends, we're going to find out which of these two portfolios has performed better. So we have SPY as portfolio number 1, and the two-fund portfolio with SCHG and SCHD as portfolio number 2 with that 70-30 split. Plugging this all in, we can see that our two-fund portfolio beats SPY by about $40,000 at the end of this time frame. Now, of course, this doesn't guarantee future returns, but it does give us an idea of how consistently this portfolio grows each year. So let me know what you guys think of this two-fund portfolio and if you'd consider owning these two ETFs, and I'll see you next time.